Today, should I sell now? Revisited. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest posts covering finance and property news with a distinctively Australian flavour. Yesterday I published a video entitled Should I Buy Now?, which was well received, even if it was just an update from last year. It's a question that many are asking. But here is another question, which in a way is even more tricky. As property owners, should I sell now? Today we discuss this, a subject which I first covered last year too. The short answer is, it depends. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here is the link, or consider joining our Patreon program, again, here is the link. We really appreciate your support to help us to continue to make great content. The links are also in the comments below. As prices continue to fall, and given the weak lending data which we discussed a couple of days ago, see down, down, lending is down, we expect the slow slide to continue. So, no surprise then, the question that is now being asked is, should I sell now? It's being actively discussed in our community. Once again, a necessary caveat, as this is not financial advice and your own mileage may vary, but I think there are some principles which are worth exploring in general terms. So today, I'm going to touch on some of the most important ones. First, we think the answer will vary by the type of property holder that you are. For those owning a property to live in, for own occupation, to provide shelter, you may have reason to switch properties, perhaps because of moving with a job, or to trade up, or to get more space, or to trade down, to get a smaller place, and possibly release capital on the way through. Now here is an important point. You only need one property, just one. So at any point in the market cycle, if you sell to buy, you are crystallizing value in your existing property at that point in time, and when you commit to buy a new place at the same time, you buy and sell at the same point. So in a relative sense, if you buy and sell, you transact at a specific point in time, and even if values have fallen, so you have lost some paper equity in your existing place, the property you are buying may well have fallen also. Although, of course, different markets may be moving at different rates, and even different types of properties may have moved differentially, but generally selling and buying can be done at any time, provided, of course, there are properties to buy and prospective purchases for your existing place. It might be much harder if the market itself has frozen, but at the moment there is plenty of properties for sale. But often you'll have a mortgage on your existing place and you are selling, and often that needs to be repaid from the proceeds of sale. That's fine, provided you've got enough equity, even if the capital value has fallen. But it could be a real barrier if the value of the mortgage is higher than the property, the so-called negative equity problem. And in fact, it is negative equity which can become the barrier to switching property, as we've seen in other markets where prices fell 30 to 40% from peak to trough. And as we discussed recently, given the falls of up to 20% in some places, we estimate around 10% of households are now currently in negative equity, and this will continue to rise as prices fall. But if you have enough equity to repay the mortgage and need a mortgage for a new place, you may have to apply afresh. Of course, bear in mind that lending standards may have become tighter, so you might not be able to get the same value of loan as previously, and this is also true if your circumstances have changed. So it is worth checking this out early. Generally, mortgage borrowing power has been reduced in recent months, or perhaps your mortgage is portable. In fact, loan portability is often a standard on all home loans, but you may have to ask, and sometimes it's not obvious. This means if you choose to move houses, you can take your loan with you. So in this case, you are able to transfer your existing loan to another property without having to go through the process of refinancing. But you will need to ask the lender for the hidden rules and parameters. And generally, you may have to pay slightly more for the flexibility of portability. And overseas, some lenders even allowed negative equity to be transferred to facilitate a move. Sometimes people will try to sell, rent, and wait for the market to fall further before buying. That might work, but you are essentially taking a bet on the market. You might be right, you could be wrong. And as I've said before, predicting future home price movements is a mug's game, and most predictions will be wrong. There are too many moving parts. Finally, if you are trading down or seeking a smaller place to release capital, you may want to bring the transaction forward because larger value homes are falling faster than smaller ones. On the other hand, those seeking to trade up and get a larger place might do better to wait, as prices may fall so you can get a larger place for less money. But again, you are betting on the market and you may be wrong. One other scenario to consider is being forced to sell, because perhaps the mortgage repayments are just too demanding. In fact, we have more than 1 million households now in mortgage stress, and incomes remain flat as costs rise. The number facing difficulty is therefore increasing. Now, the banks have an obligation to assist in cases of hardship, and they may be able to restructure the loan or even waive interest payments for a bit in this case. They are also loath to push people out of their homes as a forced sale, as this risks significant negative publicity and may also reduce the value of the property in the process. But they often encourage stressed households to sell, and we are seeing a rise among these households. So households come to accept there is no way out but to sell in this situation. Is probably better to sell sooner rather than later. As in our experience in the current environment, the cure rate is very low unless the problem is created by a short-term health or employment hiatus. But often it's a matter of the income just consistently not covering expenditure. So selling in these circumstances can in fact be a positive circuit breaker, and in a falling market, selling sooner may yield higher net returns. So now to property investors. The equation here is quite different. We are already seeing some sassy property investors selling to realize the capital gains they have achieved already. Remember that value is not true value until it's crystallized. In some cases, this is to reinvest in the smaller markets of Adelaide and Hobart, where capital gains have been seen more recently, although this may change ahead. Many in the real estate industry argue that as prices fall, the gross yield, the ratio of purchase price to rental payments, is improving, even though in some centres rents are also falling. For example, in parts of Perth, they're down more than 20%. But the truth is that gross rental yield tells you very little. You need to look at net rental yield, which is the flow of rental payments, less the cost of managing and maintaining the property and repaying the mortgage. Our analysis shows that more investors are in fact in a net negative cash flow. So unless you can see rapid capital growth and offset losses against other income, it might be time to sell. Our latest data shows that about half of all rentals are underwater on a cash flow basis, especially in Victoria and New South Wales. Some other states, such as Queensland, are doing somewhat better, mainly because values have not lifted so high, so mortgages relative to rental streams are smaller. Here are the top worst areas for negative cash flow and the best areas. So it pays to shop around, as the outcomes are remarkably different. The fact is, for many of the true all-in returns, even allowing for capital appreciation, are remarkably low, and many investors do not do the calculations to know the real picture. They'd get a really nasty surprise. And if capital values continue to fall, net yields will drop also. And in addition, of course, rental rates are more connected with incomes rather than home prices, so changes in capital value or even mortgage rates do not get reflected in most rents. But this, by the way, is a pre-tax picture. Talking of tax, the current generous tax incentives are used by many, especially more affluent households, to reduce their effective taxable income. Therefore, the government can say that most negatively geared investors do not have large incomes. It is stating the obvious, as net income is after all the tax manipulation. Some investors are choosing to sell to lock in significant capital gains, and again, the tax breaks are generous, fearing that values may fall further ahead. Others are being forced to sell to meet or avoid higher mortgage repayments as they move from interest-only loans to principal and interest loans. This is especially true for those holding multiple properties, and many have more than 5 and some more than 20 leveraged investment properties. So they sell to cover the costs on the others. And once again, those seeking a mortgage, it's important to remember that mortgage underwriting standards are much tighter now, including a 20% haircut on rental streams to cover times when the property is vacant, a repayment assessment made on a pre-tax, not post-tax position, and on a principal and interest basis, even if you're applying for an interest-only loan. And significantly more questions and evidence are required to get a loan if you are materially dependent on the rental streams to cover the costs of the mortgage. Remember that Labour would ban negative gearing for new, already built property, but they do not plan retrospective changes, so existing negatively geared loans would retain the more attractive arrangements. And they still have tax breaks for newly built property. This is likely to bring some transactions forward and have a small negative impact on prices and rents if implemented, but it's not the potential disaster portrayed by the other side of politics. Generally, in a downturn, it's investors who flee the market first, as data from Ireland and the UK both show. And this is why investor mortgages are riskier, the Bank of England says 4 times more likely to default. So my perspective would be that investors might seriously want to review their portfolios and estimate the true net returns. Given many will have paper profits on capital gains over recent years, there is a strong logic to sell. But again, it does depend on your view of future home price movements. As you know, we hold the view that prices are correlated with loan availability. And because loans are now harder to come by, property prices have further to fall. We think they are at least 30% overvalued compared to their true economic value. And so the bottom line is this. Property investors have more of a burning platform to act and consider selling before prices fall further. Down traders would also be in a similar position, as they are also seeking to lock in capital growth. On the other hand, up traders may prefer to wait, assuming prices will fall further, and those owner-occupied sellers who need to move should probably do so in any case, with the caveat that the mortgages available now will be smaller than they were a few months ago. Again, to reiterate, this is not financial advice, and it's just my hopefully informed opinion. But you would need to get more specific guidance based on your individual circumstances. Before I go, a reminder that our next live stream event is now scheduled for Tuesday the 19th of February at 8 p.m. Sydney time. Here is the link to the reminder. And you can ask a question live or send them in beforehand via my blog. The link is in the comments below. I look forward to seeing you there. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.